Have you ever wondered whether there is a specific number that quietly changes how your bank views a transaction? Most people assume that if they deposit their own money into their own account, nothing unusual happens. No alerts, no questions, no hidden paperwork. After all, it's their money. But federal law says otherwise. The moment a cash transaction crosses a certain threshold, a report is automatically generated and sent to a federal agency. No message appears in your banking app. Your teller won't hand you a notice. You won't receive a letter in the mail explaining what happened. In fact, you're not supposed to know it happened at all. For millions of Americans, this process takes place every year without creating any problems. The report simply becomes another record in a government database and is never looked at again. The real danger begins somewhere else. Ironically, it starts the moment people learn that the reporting rule exists. Because the reaction that feels cautious, the decision that sounds responsible, is often the exact behavior federal law was written to prevent. Over the years, ordinary Americans have faced investigations, frozen accounts, and even federal court proceedings, not because their money was illegal, but because they tried to avoid triggering a report they didn't fully understand. Some people have temporarily lost access to their own savings before ever being convicted of a crime. In certain documented situations, funds were seized before formal criminal charges had even been filed. And perhaps the most surprising part is who gets caught. Not career criminals, not professional money launderers. Often, it's retirees, people who spent decades working honestly, paid their taxes, saved carefully, and followed the rules throughout their lives. Then, after retirement, they received an inheritance, sold a vehicle, or deposited cash they had legally accumulated over many years, and made one innocent mistake based on advice from friends or family. That single decision transformed an ordinary banking transaction into a legal problem they never imagined. My name is Carol Haynes. For more than 13 years, I've worked as a certified financial counselor, helping retired Americans understand the financial rules that rarely get explained until something has already gone wrong. Retirement comes with an entirely different financial landscape. Income arrives differently, savings move differently, and many of the banking rules that affect retirees are never discussed by banks, government agencies, or even financial professionals unless a problem has already appeared. That's why I create these videos. If practical financial guidance designed specifically for retirees interests you, consider subscribing, because there is much more to cover in future videos. But before thinking about the next lesson, stay with me through this one. Understanding what we're about to discuss may help you avoid a mistake that is surprisingly common and remarkably easy to prevent once you understand how the system actually works. Let's begin with the number that causes so much confusion. Under the Bank Secrecy Act, financial institutions throughout the United States must submit a report whenever a customer conducts more than $10,000 in cash transactions during a single business day. This report is known as a Currency Transaction Report, often abbreviated as a CTR. It contains identifying information such as your legal name, social security number, date of birth, address, the exact amount involved, and details about when the transaction occurred. Federal regulations require the institution to submit that report within a limited period after the transaction takes place. Customers are generally not provided with a copy, and bank employees are prohibited from notifying them that the report has been filed. That silence is intentional. The reporting process is designed to happen automatically without customer involvement. Now, here's an important distinction that many people misunderstand. The reporting requirement applies specifically to physical cash currency, not electronic transfers, not direct deposits, not checks. If your monthly Social Security payment arrives through direct deposit, this rule is not triggered. If you move money electronically between two bank accounts you already own, that's different as well. The law focuses specifically on transactions involving physical cash entering or leaving the banking system. There's another detail that surprises many people. Banks don't simply look at one individual deposit. They calculate the total amount of cash transactions completed during the entire business day. Imagine someone deposits $5,000 in cash during the morning at one branch. Later that afternoon, they visit another location and deposit another $6,000. Although neither deposit exceeded $10,000 by itself, together they total $11,000 for the same business day. From the bank's perspective, that is treated as one reportable cash activity. Changing branches or making multiple visits doesn't matter. The institution evaluates the combined daily amount, not each transaction in isolation. At this point, many retirees assume the rule probably doesn't affect them. Perhaps most of their income comes from Social Security or a pension, and they rarely handle large amounts of cash. That assumption can create a false sense of security, because retirement often brings situations that have nothing to do with regular monthly income. An inheritance, the sale of a home, proceeds from selling a vehicle, cash accumulated over many years, required retirement distributions, or insurance settlements. These events may occur only once in a while, but when they do, they often involve larger amounts than people normally deposit. Fortunately, a currency transaction report is not an accusation. It does not automatically trigger an audit. It does not mean anyone believes you've done something wrong. Every year, financial institutions submit millions of these reports involving entirely lawful customers conducting entirely lawful transactions. In most cases, nothing further ever happens. The real issue arises only when additional circumstances cause those records to receive closer attention. And that brings us to a second reporting system, one that many Americans have never even heard of. Unlike the first rule, this one doesn't begin at $10,000. In fact, it doesn't require any minimum dollar amount at all. This report is called a Suspicious Activity Report, commonly known as a SAR. Today's financial institutions rely heavily on sophisticated monitoring systems that scan millions of transactions every day. These systems aren't looking for proof of a crime, they're looking for patterns. One of the most common patterns involves repeated cash deposits that appear to stay just below the reporting threshold. To understand how easily this can happen, consider the example of Helen, a 68-year-old widow. She needed to deposit $22,000 in cash that her late husband had legally accumulated over many years. A well-meaning friend warned her that depositing a large amount all at once would attract government attention. Trying to be cautious, Helen decided to spread out the deposits, $9,000 the first week, $8,000 the second, and $5,000 the third. From Helen's perspective, she was simply being careful, but the bank's monitoring software saw a pattern designed to avoid the $10,000 threshold. As a result, the bank automatically submitted a suspicious activity report. By law, the bank was prohibited from notifying Helen. Everything seemed normal to her, yet a federal report had been created because her transactions matched a suspicious pattern. Under federal law, intentionally breaking up a cash transaction for the purpose of avoiding the reporting requirement is called structuring, and structuring is itself a federal criminal offense. This surprises nearly everyone because the legality of the money isn't the issue. Even if every dollar belongs to you and was earned legally, dividing it to avoid a report is treated as a crime. The focus isn't where the cash came from, the focus is why the deposits were arranged that way. Depending on the circumstances, a structuring conviction can carry substantial financial penalties, prison time, and civil asset forfeiture, allowing the government to seize the funds while the legal process unfolds. Years ago, a federal review revealed that a significant majority of structuring-related seizures involved ordinary people with legally obtained money. This prompted major policy changes. In 2015, the IRS announced it would generally avoid pursuing seizures involving legally sourced funds unless additional illegal conduct was involved, and Congress later enacted further restrictions. However, structuring remains a federal offense today, and other authorities like the Department of Justice can still prosecute cases. Fortunately, there's a remarkably simple way to avoid all of this confusion. Instead of trying to make a transaction appear smaller, make it easier to understand. The goal is documenting it clearly enough that its purpose is obvious from the very beginning. Consider Margaret, a 72-year-old retired librarian who inherited $38,000. Instead of dividing the money, she chose complete transparency. She brought the estate settlement paperwork, the will, and the death certificate straight to the bank. She deposited the entire amount in one transaction and asked the teller to note the source in the records. A currency transaction report was filed routinely, and that was the end of the story. No frozen accounts, no investigations, and no questions. The documentation answered everything up front. The lesson here is simple. Maintain records while they are easy to obtain. If you sell a vehicle, keep the signed bill of sale. If you receive a family gift, keep a brief written statement confirming it is a gift and not a loan. If questions ever arise, organized documentation will save you enormous amounts of time and stress. Additionally, remember that bank reporting rules and federal gift tax rules function completely independently. For the 2026 tax year, the annual federal gift tax exclusion allows you to give up to $19,000 to another person without triggering a gift tax reporting requirement. Trying to split a $15,000 family gift into 3 separate $5,000 cash deposits out of fear of bank rules won't change the tax status, but it will accidentally trigger a suspicious pattern at the bank. Whenever you prepare to deposit a significant amount of cash, follow this practical checklist. First, gather your supporting documents at home. Second, deposit the entire legitimate amount in one straightforward transaction. Do not split it across days or branches. Third, speak directly with the teller, explain the source, and ask them to note it in the transaction record. Fourth, maintain your own personal records for any large transactions as inexpensive insurance. Some people think they would be better off keeping large amounts of cash at home to avoid these rules entirely. But money stored at home isn't protected by federal deposit insurance against fire, flooding, or theft. It earns no interest, meaning inflation quietly reduces its purchasing power every year, and it becomes much harder to explain and prove its legitimate history down the road. Federal reporting is not the real danger. Routine reporting happens every day to millions of law-abiding Americans. The greater risk comes from misunderstanding the rules and making decisions based on incomplete advice like, just keep every deposit under $10,000. When you have legitimate funds to deposit, be transparent, keep supporting documentation, and handle the transaction honestly. Allow routine procedures to take place without trying to work around them. Understanding the rules gives you the confidence that your careful planning and straightforward banking practices will always place you in the strongest and safest position.